All right, now welcome to topic 2. So topic 1 we talked about, right? These permanent whole life products. And those were the products that were first invented, right? But now, right, we have some new types of policies that have been invented, right? Late 1900s and 2000s, right? And so we have now these adjustable life products. And so with these, we really want to focus on with adjustable, right? There's going to be that change in premium, or that's going to be that change in death benefit, or that's going to be that variability in cash value. So let's take a look at universal life first. So universal life is a flexible premium adjustable life insurance policy that allows the policyholder to adjust premiums and death benefit, right? So contrary to traditional whole life, with universal life, policyholders can increase or decrease premiums within certain limits. So depending on that, the death benefit can be adjusted, right? It can change. So if you pay more premiums, then your death benefit might be higher, right? If you pay less, then it might be lower. But there's always a fixed growth cash value, right? So with universal life, right, just regular universal life, the death cash value still has a minimum interest rate guarantee. Usually it's around 2 to 3%, but it is a kind of that guaranteed interest rate. Okay, so now let's look at variable whole life. So this is a whole life policy where the cash value is invested in a variety of separate accounts. So this can be stocks, money market, bond, other securities. So with this, we have fixed premiums, guaranteed death benefit, but the cash value changes, right? Because it is based on the performance of all of these accounts, right? And so in this case, there is what? There is no minimum interest rate guarantee. So sometimes, right, the kind of downside of this policy is if you are in an emergency and you borrow against the cash value, but the separate accounts have been performing badly, right, then what happens? Well, sometimes, you might not have any money to borrow against, right? You can't borrow against the cash value because it fluctuates so much. So the key thing to really learn these, kind of memorize these different types of policies is hopefully realize now that you really need to know about premiums, death benefit, cash value, right? How do those change depending on the type of policy, right? Universal life have these flexible premiums and death benefits, right? But with the variable whole life, we have these flexible or variable cash values, right? So kind of really think about that when we're talking about this. And everything I underline is very important. Everything I bold is also very important. So now let's take a look at what my variable universal life is. We looked at variable whole life and we looked at universal life. So when we combine them together, right, we can see that variable universal life encompasses characteristics of both. So there can be flexible premiums and adjustable death benefits, just like universal life, but there's also that investment option, right? Hence, it's called variable as well, right? And there's no minimum interest rate guarantee, just like variable whole life, right? So there's that combination of universal life and variable life. And we can see here that there's currently this new type of policy called index life or index universal life. You might have seen this in the seminars that have been given out recently in the insurance world. It's become pretty popular. And let's talk about why. So index life is a permanent life insurance where cash value is tied to a specific stock market. So when we look at this, the good thing is that there's a guaranteed minimum interest rate. Okay. But it also provides flexibility in premiums and death benefits. So there's this guarantee, but it also provides flexibility in premiums and death benefits. So wow, that's a good thing, right? You have flexibility, but you also have minimum guarantee. So this was why index life or index universal life has now become more popular. Okay. So let's go through these again. You have universal life, you have variable whole life, you have variable universal life, we have index life. And you really, really, really need to go through these right, characteristics, because on the exam, they can give you definition questions, but they also give you contextual questions. And I say, oh, a client wants to purchase a policy with variable cash value, but also a fixed premiums and death benefits. What would be appropriate? It would be this one, right? So kind of just need to really know that so you're aware. Okay, so now let's do a quick activity. Let's match which cash value growth shows variable and which cash value growth shows the indexed policy. Okay, so we should be able to tell that the one on the left is a variable policy, right? Because we see that variability in cash value. On the right, it's an indexed policy, right? Because the cash value never decreases, right? Because the interest rate is guaranteed, right? So the cash value shouldn't be dipping, right? Because there's no negative interest rate. So when we take a look at our cash value, we can often use graphs to help us memorize on the examination ways in which index life, right, and variable life, right, are related and different. Okay. Now, something interesting, right, just as I mentioned with the IUL or index universal life, is that we can look at these charts, right? So we can see that with the interest rate, right, there's a cap and a floor, right? So there's rates, right, that kind of constrain the IUL interest rate, but we can see that there's no negative return, right? So that helps to ensure that there is a always at least, right, that minimum interest rate, right? And even when the index return is negative, we can see that the policy, right, or the policy holder won't have any drops, right, in cash value. If we want to look at this a different way, right, because this chart kind of shows that annual return, we can look at this here. This is more with the index and cash value, right? So we can see that the cash value never dips, right? If it's initially 100,000, it's never decreasing, because with the IUL, remember for the exam, you want to know about this, right? With the index life, it has that minimum guaranteed interest rate. So even when we see that we have this drop, right, an index value, okay, this floor, right, floor rate protects the cash value from dropping, right? Instead, it's just locked, right? So whenever we have that decrease in index value, right, from maybe the S&P 500, right, we can still see that the cash value doesn't change, right? Maybe showing that like 0% annual return, right? But there's no negative annual return. Okay, but this is just something that kind of brings you curious to this. But on the exam, right, for sure, we don't really need to know about the floor cap, floor and the cap rates. But this is something interesting to help you better understand indexed universal life. All right. Now, something that I do want to bring your attention to as you're preparing for the examination is that with variable products, right, that we talked about, or we've talked about already, the variable universal life, the variable whole life, that although you do need to know for examination, but you can't actually sell variable products with this license. So, well, you do need to know about, all right, the characteristics of it, but there are specific details that kind of go beyond, right, what you need to know for the exam for the exam, and so you can't sell variable products at this stage. But once you obtain this license, you can for sure take this exam, and then you can eventually be able to sell these variable products. Okay, all right. Now, besides from our individual plans, we also have something called these special combination plans that we want to know for the exam. And so the first type of plan is the joint life insurance. Okay, so this is a life insurance policy that covers two individuals and pays out the death benefit upon the death of the first insured person. Okay. So this is in contrary to what we've talked about, right? In the previous slides, no matter when we looked at topic 2, right, with adjustable life products, or in the other topic 1, right, with these whole life products, right, those were mainly geared towards, right, these individuals, right, one individual. But we also have these joint or these special plans, right, that can help to cover two individuals, okay? Another thing that we want to look at is the survivorship life insurance. Okay, so this is a life insurance policy that covers two individuals and pays out the death benefit only after both insured individuals have passed away. So we can see that these are two different types of these special plans or special combinations that we want to be aware of um, before he's entering the exam. Okay, so joint life insurance, we can think of like first to die, and survivorship life insurance like second to die, right? Because it only pays out death benefit after both insured individuals have passed away.